Hey, welcome to Real Estate Today. I am Ryan Cook with HomeSmart First Class Realty, and I'm here with one of my preferred lenders, Greg. Greg, why don't you introduce yourself?
Hi, I'm Greg Page with First Class Mortgage Company.
Fantastic. So Greg and I are probably going to do this on a weekly basis, and the whole point of this podcast is we're not focused on mortgages and not focused on buying and selling real estate. What we're trying to do is get the information about what's happening in the real estate market, have a discussion about it so it's understandable to the average person out there, and hopefully you're able to use that information. And then based on that, if you think it's worthwhile to reach out to either of us for additional help, we'll be here for questions, emails, whatever the case may be. That's sort of the format. It may be finance, it may be just general real estate news or something that the federal government's thinking of doing as far as maybe changing mortgage insurance rates or whatever the case may be. So we'll try and bring relevant stuff to you on a weekly basis. So that's pretty much it to you, Greg?
That sounds about right to me, Ryan.
All right, so perfect. So I'm looking at my list today. There are two actually pretty unique programs that you actually told me about a week and a half ago that I was like, we should probably do a podcast on this. One is called MaxOne, which is a down payment assistance program for FHA. Federal Housing Administration. So we'll tell people what FHA is once we get started here, because I was want to sure we never want to assume people understand what we're talking about because we do this all the time.
There's a lot of complexities to it. Yep.
There are. And then the second program we want to talk about is the MI Buster, or the Mortgage Insurance Buster, which is a pretty, as the way you explained it to me, 10.1% is the new 20% down.
Yep.
All right, perfect. So we're going to start with the MaxOne program. So what can you tell me about this MaxOne program that's a little bit different and why people should probably pay attention to it?
Well, the MaxOne program is a new program one of our lenders has rolled out in the last few weeks. And basically it allows for a down payment assistance program to help the borrower with 100% financing. So basically they're just bringing some closing costs or maybe the appraisal fee is all they would need to close. It allows for down to a 580 FICO score, which is pretty aggressive.
That's real aggressive. I mean, when it comes down to 580, does it have different requirements as far as, well, because this is a down payment assistance program, but other programs I've seen that'll have a lower credit score may require a larger down payment. Is that the same thing with this?
Well, typically you would think, but in this case, they are allowing a 580 FICO to be the drop dead number, and then providing on an FHA the additional 3.5% assistance through a grant program, which in itself is pretty unique because it doesn't have to be paid back until.
Well, go ahead and finish because I got a question on
that. Until you refinance or sell the property, the grant doesn't have to be paid back. It's interest-free, payment-free. So if they give you $7,000 until you refinance the property or sell the property, even after 30 years, you're not obligated to pay only the $7,000 back. Pretty aggressive.
That's real aggressive. I guess that's sort of like a Title I loan almost in a way. Just Title I is typically put towards fixing something specific in the house, fixing a repair in order to get it ready for sale.
Right.
So 580 credit score, I mean, there's a lot that goes into a credit score. With a down payment assistance program like this, do they have to qualify for FHA first and then qualify for this program second? Or how does that process work?
It's pretty much done through the underwriting of this particular lender.
So tell people what underwriting is, because not everyone knows.
That's where the processing team sends in all the documentation to the lender's underwriting team, who then compiles the information to make sure that the bank statements and the paychecks and the identification to make sure there's no fraud involved. They're basically going through the entire loan package to identify that the client is who they say they are.
Sure.
That the documentation that they've submitted is real, that it's all factual. They do verifications on employment and so forth, that the taxes are real. And if everything matches up and it meets their requirements, they move forward to help the client buy the home.
All right. So I've had a lot over the last couple of years. I've had a lot of first-time buyers that are having a parent or some other, close relative
Yeah.
assisting with the purchase, maybe as a cosign. Does this MaxOne program have any restrictions as far as, a non-owner occupant co-borrower, someone co-signing on it? Would this restrict them?
As of right now, no.
Oh, that's pretty amazing.
Yeah, it's a pretty aggressive program. Again, the fun thing about this industry is, as you know, there's a lot of changes and they happen on a regular basis. We get documentations and emails typically twice a day. And when we saw this program and the one we're going to speak about next, we were all blown away by it because it is extremely aggressive. And the goal at the end of the day is basically to help more people buy more homes and get and achieve the American dream of home ownership.
Sure. Now, with a lot of these programs, income assistance, like I'm thinking where we are in southeastern Massachusetts, a lot of the industrial cities, Taunton, Fall River, New Bedford, Brockton, et cetera, will have down payment assistance programs specific to that area. Like Pro Home is one in Taunton where they'll do down payment assistance. There's like a pool of money available for the year. And once it's gone, it's gone. But typically they have income limits, like you can't make over a certain amount. Are there any income limits on this MaxOne program?
As we speak, I have not seen that to be the case.
Okay.
Obviously, we're trying to help people maybe who haven't been able to buy a home in the past. But as we speak now, I have not seen any limitations being rolled out by this particular lender. Okay.
So in summary, we're looking at as low as a 580 FICO score with no funny business, as far as you know, no first-time home buyer requirements. You can have a non-occupant co-borrower, so mom, dad, brother, sister. I mean, who can sign on and still get this down payment assistance. It's going to be the 3.5%, which is typically what you have to come out of pocket with on an FHA loan, and there are no income limits. That pretty much sum it up.
As far as I know, as we speak, yes.
Honestly, I've been doing this over a decade. That's one of the I think that is the most amazing down payment assistance program I've been exposed to.
Yeah, I mean, the grant itself, just the fact that it is zero interest, zero payments, is pretty aggressive. But again, the government's looking to help more people achieve home ownership, and this is just one more step in that process.
But the difference here with this grant is other grants I've seen in the past where you'd get, say, down payment assistance, the payment would decay. So it'd be like, say it'd be over 5 years. So after the first year, 20% of that down payment would be waived. And after the second year, another 20% would be waived. So if you stayed in the house like 5 years, you wouldn't have, it'd be a real grant. You wouldn't have to pay anything back. This one, no matter what, this will have to be paid back
at some point.
At the time that you either refinance or sell, right?
That's correct. As you mentioned earlier, there are some local programs with certain demographic areas, Fall River, New Bedford, whatever it may be, offering these programs. As you mentioned, after 5 or 10 years, whatever it may be, they do degrade, and at that point, there's nothing to pay back. The one we're discussing, there is a payback, but it's payment-free, interest-free.
Yeah, that's pretty amazing. And you can pay it back if you want earlier.
Yeah. They don't have any problem getting the money back.
Okay. The other program, which this one, 10.1% is the new 20%, the mortgage insurance buster program. And this is specific to one of the wholesale lenders you work with, right?
That's correct. Yeah.
All right. So why don't you tell me a little bit about this one, because that 10 or 10.01% down, I was like, okay, what is there a catch? Like I was sort of waiting for like the, pull the rabbit out from the hat.
Drop. Yeah.
Yeah. I mean, like, so what exactly is this program?
Well, let's use a $500,000 home as an example. If you have to come to the table with 20% down, you're walking in with $100,000. Mm-hmm. With only 10% down, 10.1% down, you're looking at about a $50,000 reduction in the down payment required to purchase that home.
Yep.
That can transfer into more home that the client can buy, more money they can keep in the bank and utilize it should they want to have any renovations when they get in there. Mm-hmm. It offers a lot of opportunity for your agents to be able to show more properties, maybe at a little bit higher value. It's kind of a game changer because we've all grown up with the 20% down if you don't want the MI, the mortgage insurance.
Right.
When this
Yeah,
rolled
and
out again.
so
this was
just so
a shocker.
people understand, like, can you, I mean, so I think people know what mortgage insurance is. Like a lot of people are still under the misconception that you have to have 20% down to buy a house. And that's not true. I mean, you have here in Massachusetts, you have Mass Housing, which is 3% down, no MI, although the MI is
You
actually
just spoke about 100% financing. So,
right. Right. But so just so people understand, like that 20% is a myth. You don't need 20% in order
That's
to purchase
correct.
a home. Okay.
That's correct. Yes.
Now, typically, when you don't have the 20% down, a lot of mortgages require you to purchase mortgage insurance.
Right.
Now, mortgage insurance, why this is such a pain is it's a percentage of the amount borrowed, right?
Correct.
Is a fixed percentage?
I believe it's 1.75 in most cases. That's the number I
All right.
remember.
And then, so that 1.75%, so what you have to do is, along with your mortgage payment, your insurance, and your taxes, which that's one part of the payment, there's another part of the payment, which is the mortgage insurance. And why it's a pain is when you do your taxes, you can write off the interest paid on your mortgage. You can, but you can't write off the mortgage insurance portion. So it's just money going out the door. That's not benefiting you as a homeowner and helping you build wealth, right?
And what a lot of people don't know is that when your home value gets to the 80%, you're entitled to call your realtor and ask that it be removed. But a lot of people forget about it. They don't recognize the value.
Call the realtor or call the lender?
The lender.
Yeah,
Sorry.
okay. I was like, call the realtor. I'm like, hey,
no,
like, who's your lender?
Now, call the lender and they can say, we've reached the 80%. By a law, they have to remove it at 79%. Now, who's paying attention?
And that's the question, paying attention. So I've had, I actually do that for my clients. Actually, I should go back and change that. When we used to know the interest rate and I could see what their payments were, but when they changed all those laws, 2015, 2016, and they changed it to a CD from a HUD, so a closing document, and the interest rate and stuff like that, because I would just say, oh, it's a 30% loan at 5.25%. And I could easily calculate their amortization schedule and see, where their payments are, so that if I look at the value of their home, I go, hey, I would send them alerts like, hey, you're getting really close to 20% equity in your home. Like, we should be reaching out to your lender to do to at least get the mortgage insurance taken off, or looking at a refi. Now it's hard for me to do that. So how do we keep track of that?
As a wholesale broker, that's not our world. It's really on the homeowner and the lender to have that conversation. We do have programs where we are looking. Some of our lenders actually have it built into their websites where we can go in, because obviously we want to maintain a good relationship with our clients. And anytime we can reach out to them and say, hey, with the values that have gone up the way they have, and you're 5 years into your mortgage, this may be a good time to take a look and see where we are today. Again, with the home values rising the way they have recently, some of these people are recognizing that ability to remove it faster than others.
Sure. So, now, does it require them to get an appraisal of value from a licensed appraiser, or can
not really? No. I mean, typically the lender will look at it and make the determination, because it's kind of their way of making sure you have skin in the game. With the fluctuation in the market the way it is, if things do turn around and go upside down, it gives them some skin that they're not going to lose any of their investment should there be a market, I don't want to say reset, but as we know, values have gone up and they've gone down. And after what happened back in the day, we saw a lot of values drop pretty drastically. So it's basically just a way for the lender to make sure that they're having some coverage should there be another turn like that.
With a program like this, when it comes to interest rates, like, I try and explain to clients, like, there are thousands of lending programs out there from different lenders, and not every lender has access to every program, and different different loans will have different interest rates depending upon the terms of the loan, your FICO score, your debt to income ratio, other, your there's like adjusted gross income or something like that. Like we look at all that stuff, but are the interest rates on this mortgage insurance buster program, same as they're going to see, or are they offset a little bit?
Oh, no, they're pretty much spot on. So one of the things that sets us apart, because we are a broker, we can deal with, as many lenders as we want. And we're currently signed up with quite a few of them, offering a wide variety of programs, as you mentioned. The other thing is when a client goes to a bank has their program. Here it is. If you go to, say, Bank of America, they have no vested interest in saying, hey, you know what? We're Bank of America. Here's the rate we're going to give you. Here's the program we offer. But if you went down to the street, so Wells Fargo, they got a much better deal going on. As a broker ourselves, we have a vested interest in ensuring that we're securing the best possible program for our clients. We want to make sure that they're getting the best possible deal available. And that's what we do. We have systems in place where we can actually see who's doing what, where our clients' needs are going to best be met. And that's our job, is to make sure that we find the best product and program that fits their current needs. So having these two new programs has just been a mind boggle, because, as you know, whoever heard of, it's always been 20%, but not anymore. It's always been 100%, but not anymore. So,
right. I mean, sometimes like there's a local lender that may have a very short-term program where it's 10% down with, no MI or no, but they're keeping that in-house as a portfolio loan. And it's normally like the money they're lending out in the community, that ratio versus what they're taking in from the community is off, and they got to get money out of the community. And it's like, you got 30 days max to take care of that program. This is something that is available to anybody at any time.
Well, yeah, and as you and I spoke earlier, we literally get, on average, 2 emails a day from our lenders, and some of them have videos like this, and others just say, prices are better, prices are worse. Yeah. They'll explain why the bond market's doing this or whatever it may be. So it's a really fluid situation that changes on a whim. So yes, to your point, there are community lenders who will have specials that they run, and if you're lucky enough to walk in the office that day, they're going to tell you about it. But our goal is to utilize our vast lending capacity with the various wholesale lenders that we deal with to ensure that our clients get the best possible deal.
All right, fantastic. So today we went over, looking at my notes, I'm not looking down and just away. We went over the MaxOne program, which is down payment assistance program for FHA finance buyers. 3.5% down. It's a grant, no interest, no payments until you refinance or you sell the property. Yep. And we went over the mortgage insurance buster program, where 10.1% is the new 20%. So on the average price of a home in this area, which is close to $500,000, it could save you $50,000 in out-of-pocket expenses in order to be able to purchase a home, which you could then put that into renovating your home or whatever the case may be.
Yep.
Fantastic. All right. So this has been a fantastic first episode of our Real Estate Today podcast. Next week, we're actually going to bring a guest on, a guy named Jim Dring. You want to tell me a little bit about Jim really quickly?
Yeah, I've worked with Jim for over 20 years. He now represents a bank called Quantic, and Quantic is a national bank that provides a variety of programs, most notably their non-QM.
Now, what is QM? What does that mean?
Quality mortgage. Non-QM it's not subprime, but it's people who maybe have a different way of reporting their income. Not everybody goes to work Monday through Friday.
Right. So basically non-W-2 employees.
Pretty much. Gig workers, business owners, whatever it may be.
Okay.
They have a nice variety of programs that opens up a whole new world for us to help your clients buy the homes that maybe a traditional lender is not going to allow them to do.
All right. So
Jim will bring a wealth of information.
Yeah, that should be pretty cool. I mean, the whole point of doing this and why you and I sort of talked like, hey, we should probably put some sort of podcast together is there are a lot of misconceptions about real estate and mortgage financing and all that stuff. So really, this is sort of like a demystifying, taking the myth out of a lot of this and trying to explain it in layman's terms to everyone out there so they become more educated consumers, brings down the stress level and the anxiety levels because they know, we're going to talk about if something's good, we're going to tell them it's good. If something's crappy, we're going to tell them it's crappy, and we're just going to explain it in easy to understand language, hopefully.
Well, at the end of the day, Ryan, I mean, when your agents are out showing properties and somebody mentions, well, I'm an Uber driver, that's okay.
Mm-hmm.
It shouldn't cast a shadow on their ability to buy a home, because there are lenders who go, that's fine, come on in.
Mm-hmm.
So hopefully this podcast and the future podcast will, as you said, shed a light on the potential, the opportunities, and hopefully it'll allow your agents to sell more homes.
Or any of the agents out there. I mean, it's really, how can we help agents improve how they serve the clients in the community? And this is just one of the ways we're trying to get that information out there. So this is something for both agents, lenders, consumers. Hopefully we're trying to make this something that is easy for anyone to understand and utilize. Awesome.
Absolutely.
Greg, this was a great first episode. I look forward to next week on episode number 2. But a good initial episode, and fantastic. We look forward to our next conversation.
Thank you very much. Appreciate your time.
All
Have
right.
a great day.
You too.
Bye, Ron.